If the markets stopped printing prices, if the ticker tape went dark for the next 10 years, would you still feel good owning what you own right now?
That question, it sounds almost like a parlor trick, but it's devastatingly effective.
Why is that?
Because it quietly exposes nearly every single investing mistake we make. It forces you to confront the underlying reality of your holdings, rather than relying on that ephemeral, daily fluctuating market sentiment.
Well,
The quote.
because if you can't lean on that quote, that daily, sometimes hourly fluctuation, you have to lean on something much, much sturdier. You have to lean on the actual business, the legal contract you own, and crucially, the price you paid for that contract. Your conviction has to be purely fundamental, rooted in value.
And we have to add, the conviction also has to come from you, your financial situation, your personality, your temperament, and your specific time horizon.
Yeah.
The key insight, which we're going to unpack today, is that the decision is never just about whether the company is good in a vacuum. It's whether that good company is suitable for your goals at the specific moment in time.
Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes.
We create calm, audio-first deep dives that turn classic investing ideas and historical wisdom into practical decisions for today's long-term owners. Our goal is always to translate the timeless principles of the greats into actionable frameworks that you can use in our fast-moving modern environment.
Our mission is really to teach disciplined, long-term investing by revisiting classic books and core ideas. We explain them clearly, apply them in today's context,
Right.
and focus strictly on the principles that remain true regardless of what asset class happens to be in vogue or, what narrative is sweeping the headlines.
If you want more of this structured, long-term thinking, please hit like on this deep dive and subscribe to the channel. It really helps more fundamentals-minded investors find our channel. And of course, it supports the work we do here.
And as always, remember that this is strictly educational content only. It is not individualized investment, legal, tax, or accounting advice. Always consult a professional regarding your unique and specific financial situation before making any decisions.
Today, we are diving deep into the foundational text of value investing, Security Analysis by Benjamin Graham and David Dodd.
The Bible.
Exactly. We are tackling Chapter 2, which is titled Fundamental Elements in the Problem of Analysis, Quantitative and Qualitative Factors.
And this is one of those chapters that, once you really internalize its framework, it can fundamentally change your investment behavior immediately.
How so?
It does this because it reframes what a complete investing question actually is. Most people approach investing with a half-formed query focused only on the business.
Right, the ticker.
Exactly. And that incompleteness leads directly to poor, highly volatile, and often regrettable outcomes.
That's right. So to make sure we don't just admire the problem, we're going to build 2 practical tools you can carry into every decision starting today.
Okay.
The first is a 4-part question that forces clarity before you even contemplate a buy, sell, or hold decision. It compels you to acknowledge all the moving parts, including the parts you normally ignore.
And the second tool is a practical, disciplined way to balance the numbers, the purely quantitative factors with the harder, more subjective factors, the qualitative ones.
Yeah.
Getting this balance right and avoiding self-deception in the process is perhaps the most common error in investing, especially when markets are euphoric.
And we'll keep this discussion grounded by using the chapter's original historical examples, which are, surprisingly relevant today. We're talking about high-grade bonds that were technically safe but still extremely risky at the wrong price.
Safe real estate that wasn't safe at all due to bad contractual terms, and an ugly industry that, because of unusually good terms, offered a surprisingly well-protected bargain. The logic truly remains sound across decades.
So think of this deep dive as a mandatory judgment upgrade. We aren't aiming to give you a stock tip or a market forecast. We're aiming to give you a better way to structure and organize your decision-making process for long-term portfolio management.
Okay, let's unpack this. Graham and Dodd ask, what is the fundamental purpose of security analysis? It's trying to answer a practical and actionable question for the person actually writing the check.
Precisely. And if you ask the average investor what that question is, they'd say, should I buy, sell, or hold this ticker symbol?
Sure.
But Graham and Dodd immediately state that question is profoundly incomplete as usually asked. It utterly lacks the necessary variables for a responsible answer.
Right. The complete version is, should security S be bought or sold at price P at time T by person I? That is the full equation. Security, price, time, person. These are the four essential, non-negotiable factors that must enter the equation. You can't skip any of them and expect a reliable result.
4 factors. And what I find fascinating is their suggestion that we should analyze them in reverse order.
Yes.
Start with the person, then the time, then the price, and then finally the security itself.
Which, as you point out, is the precise opposite of how the vast majority of people invest.
Completely.
They start with a ticker symbol S, the hot stock or the promising industry, spend hours analyzing the business, and only end with the person alive if they consider their own constraints at all.
Right.
By reversing the order, you prioritize the constraints that actually dictate whether your judgment leads to success or failure.
So let's walk through the 4 factors in their suggested order. As we do this, if you're listening, maybe grab a notepad and honestly ask yourself, which one of these do I consistently tend to ignore?
Good question.
Because that skipped factor is typically the source of all your future regret.
That's often true. Your personal blind spot in this equation is almost always where your most painful losses originate, because it's the element of the investment you failed to control or properly account for.
Factor 1. The person. The capital allocator in the mirror.
This is such a radical departure from the standard, ratio-focused investing book. This is the human element, the context that transforms an intellectually sound investment into a successful personal outcome, or sometimes a disaster.
It's where investing meets the messy reality of life. The same high-quality security can be perfectly sensible for one person.
Say a 20-year-old.
Yeah, a 20-year-old with 40 years until retirement and 0 liquidity needs, but it would be ruinous for someone approaching retirement who requires stability and cash flow.
Graham and Dodd are quite blunt here. They say what might be an attractive, well-calculated speculation for an experienced business person who understands cycles and can withstand loss. That same thing should never be attempted by a trustee managing funds for others, or, say, a widow with limited income. The distinction isn't about intelligence. It's about the catastrophic financial consequence of an error.
The lesson is really focused on constraints. If you have responsibilities that demand stability and predictable cash flow, you just cannot treat your portfolio like a high-stakes bet, even if the isolated odds of success look favorable.
And we have to talk about the constraints beyond simple risk tolerance. There's the financial position itself.
Yeah.
If your emergency fund is thin, a market drawdown can force you to sell your long-term holdings at the absolute worst time just to pay bills.
Oh, that's a killer.
It is. In that scenario, you're not evaluating investments based on their fundamental merit. You're selling due to personal cash flow stress. That is a personal constraint that no quality asset can overcome.
So when we talk about the person, we're including tangible elements like your need for liquidity, your ability to withstand volatility, your time horizon, your tax situation, and then the more subjective elements like your actual competence and, critically, your temperament. These personal variables are just as influential on your ultimate return as the P/E ratio.
Let's drill down on taxes for a second, because Graham and Dodd mention a point that is so often overlooked.
Okay.
If a bond or an asset offers a tax exemption feature, for instance, a municipal bond, that feature has measurable value, but only if it applies directly to you, the individual investor.
So if you're holding that tax-exempt bond inside a tax-advantaged retirement account, like a Roth IRA or a 401k,
Exactly.
the tax exemption is just redundant. You're already exempt from current taxation. If you paid a premium for that tax-free feature, which you likely did,
You definitely did.
since those bonds typically yield less than taxable alternatives, you are essentially buying a feature you will never use. You've unnecessarily reduced your yield.
So, the simple modern translation is this. You cannot compare yields apples to apples without comparing the after-tax yield and considering the account type. You absolutely must calculate the tax equivalent yield to truly compare a muni bond to a taxable corporate bond. If you skip this, you're likely making an inefficient allocation.
It changes the comparison dramatically. I mean, if you're in a high tax bracket, that tax equivalent yield makes the feature immensely valuable, easily justifying the premium. If you're not, the premium is wasted.
And remember that even within the same person, different dollars have different jobs. A dollar designated for an emergency savings fund, which needs absolute safety and liquidity, is fundamentally different from a dollar of long-term capital that can afford to endure decades of volatility.
Right. Each pool of capital has a specific mandate. This is why we use the term allocation. You're allocating capital, but you're also allocating risk.
That's it. You're assigning the most risk to the parts of your life that can comfortably carry it and keeping it strictly away from the parts that demand preservation.
They also touch on competence. your training and ability to evaluate what you're buying.
This covers whether you can genuinely understand the financial statements, the competitive landscape, and the complex contracts that define your holding.
And this isn't about having a high IQ, it's about process and bandwidth.
Exactly. Certain investments, say small cap stocks with convoluted balance sheets or complex debt instruments, they require active monitoring, specialized judgment under stress, and a lot of due diligence.
If you don't have the time or the skill set to do that due diligence, the investment is wrong for you, even if the underlying business is stellar. It just becomes a source of stress and a potential error.
And then we get to temperament, which is arguably the trickiest qualitative factor of all. Some people are simply built to own volatile, high-growth assets without panicking. Others cannot tolerate the psychological pain of watching their account value drop by 30% in a month.
And we should stress, temperament is an operating constraint, just like liquidity or leverage. It is not a moral failing. If high volatility consistently causes you to panic sell at the low point, then volatility is a quantifiable risk that you must minimize in your portfolio construction, regardless of the quality of the asset.
So before you look at a single stock chart, you have to use this checkpoint. What job does this money have to do in my life?
Is the job income, preservation, high growth, optionality, or absolute liquidity? The answer provides the necessary framework for judging the other three factors. Time, price, and security.
All right, factor 2, time. T. This is where the analysis intersects with the external world and its changing standards.
Time influences analysis in two critical ways that are often confused. First, the security and the underlying company change over time. That's internal change.
Right.
Second, the standards of value change over time because the market environment changes. That's the external context.
When we talk about internal change, we mean earnings fluctuation, shifts in competitive position, new regulations, technology disrupting the process, simple managerial change. The underlying reality of the enterprise is never static.
But that external context is just as powerful. What constitutes a fair price, a good yield, or an appropriate margin of safety today might be a terrible deal 6 months from now, simply because the baseline cost of capital has moved.
Glam and Dodd provide a powerful, concrete example using bonds. They describe a high-grade railroad bond yielding 5%.
Okay.
At the time, this looked attractive because the average yield on similar high-grade bonds was only about 4.32%, so 5% was a decent relative premium.
But 6 months later, due to changing economic conditions, interest rates had risen significantly. Bond prices fell, and the average yield on that same group of high-grade bonds was now 5.86%.
Wow.
The railroad itself might be just as sound, its cash flow just as secure, but the 5% bond that was once a bargain is now unattractive.
It's underwater.
Exactly. It's trading at a relative discount because the opportunity set has shifted so dramatically.
That is the essence of relative value thinking. The question isn't, is 5% good in a vacuum? The question is 5% good compared with what the market is offering for similar risk right now? You must continuously compare your holding to the prevailing opportunity set.
This is a massive source of confusion for modern investors, especially when interest rates shift dramatically. In a long-term, low-rate environment, a 4% yield looks luxurious. In a higher-rate world, it can look thin and potentially dangerous, especially when compared to risk-free alternatives like short-term treasury bills.
So time encompasses the prevailing level of interest rates, the credit spreads that the market demands for risk, and inflation expectations, all of which change the acceptable price you should be willing to pay for any stream of cash flows.
And in the realm of equities, time also includes the market's psychological mood.
Oh, absolutely.
When the market is euphoric, it prices in perfection and eternal growth, demanding little margin of safety. When it's fearful, it prices in permanent damage, which is often when extraordinary bargains are created.
But it's crucial to understand that Graham and Dodd aren't telling you to become a macro forecaster, trying to guess the next move in interest rates.
No, not at all.
They're simply reminding you that your analysis is performed against a background colored by the times, and you have to recognize when the standard of value itself has changed, even if your security has not.
The practical mandate is this. You can maintain stable principles, like demanding a margin of safety. But the application of those principles has to be flexible enough to adapt to the current cost of capital.
If safe assets, like government bonds, yield 5%, your required hurdle rate for a risky common stock, which has no contractual protection, must be significantly higher than 5% to reflect that risk.
If you ignore the time factor, you're often just transferring money from a low-risk return to a high-risk one without adequate compensation.
Finally, nearly all market commitments are influenced by the current view of the general business outlook. The speculator depends entirely on that outlook being right. But the conservative investor has to remain mindful that in times of extreme stress, market liquidity and confidence become part of the practical return equation.
So time affects analysis through changing security fundamentals and changing market standards.
Okay, factor 3, price, P. This is the simplest factor mathematically and often the most fatally ignored.
People fall in love with a story, a charismatic CEO, a groundbreaking product, and they just forget that the price they pay utterly dictates their long-term return.
Especially in common stocks. You can accurately identify a wonderful business and still pay a price that transforms it into a mediocre investment or even a disaster that guarantees years of poor returns.
Graham and Dodd say that in selecting prime investment bonds, price is usually subordinate because, historically, the highest grade debt rarely trades at unreasonably high prices.
But then they immediately introduce the exception that proves the rule.
Well,
High-grade convertible bonds.
right. They can expose the price risk even when the underlying credit risk is almost zero.
They cite the famous case of American Telephone and Telegraph convertible bonds. The company was pristine, the borrower quality was beyond reproach, the debt was safe as to principal at par and interest.
Yet these high-quality bonds traded above 200 in 1929. The safety of the debt was undeniable, but the price paid was purely speculative, driven by that conversion feature and, market mania.
That's the critical takeaway. Just because a security is safe beyond question in terms of default risk doesn't prevent it from being extremely risky in terms of price risk.
But what happened?
When the market corrected, that AT&T bond lost more than half its market value.
We should probably spend a moment explaining the mechanics of that loss, because it's a lesson that is constantly forgotten when assets become highly priced today, whether they're bonds or stocks.
Good idea.
When you buy a bond at 200, you are paying 200 cents on the dollar, twice the par value of 100. Par is the face value that the issuer promises to pay you back at maturity.
Now, the coupon, which is your contractual income, is paid on the par value, not on the inflated price you paid.
So if the AT&T bond paid 4.5% on par, that's $4.50 per year for every $100 of par value.
But if you paid $200 for that $100 of par, the current yield you receive on your actual cash invested is $4.50 divided by $200.
Which is only 2.25%.
Right. A shockingly low current return for holding debt, especially in 1929.
And here's the killer. At maturity, say in 20 years, the issuer only pays you back the par value of $100.
So if you paid $200 for the bond and you are guaranteed to get only $100 back at maturity, that $100 difference is a certain capital loss built into the investment.
Your meager 2.25% current yield has to fight against a guaranteed pull toward par over the entire life of the bond. The loss is locked in.
The lesson is clear. There are two types of risk. Default risk, will the borrower pay me back? And price risk, did I pay so much that my guaranteed final return is zero or negative?
And Graham and Dodd teach us that you have to separate quality from valuation. A high-quality business can still be a low-quality, high-risk investment if you buy the wrong terms. And paying $200 for a bond redeemable at $100 is unquestionably buying the wrong terms.
Conversely, a lower quality asset can transform into a decent investment if the price and protections are unusually favorable, which leads us to the final factor.
Factor 4. The security S.
And Graham and Dodd introduce a crucial distinction here. Don't just ask, in what security? That's too shallow.
Instead, ask two much deeper questions that force analytical rigor. In what enterprise? And on what terms is the commitment proposed?
That split is brilliant. The enterprise is the underlying business itself. The assets, the revenues, the management, the products.
Right.
The terms are the contract you're getting, the price, the seniority, the covenants, the status of the issue within the company's capital stack.
And they demonstrate that you can invest in the soundest enterprise imaginable on terms so unsound that they negate the enterprise's quality entirely.
Their first negative example is pre-1929 New York City real estate. At the time, this was widely viewed as the safest medium of investment. Manhattan property had a long, steady record of value growth.
It was a blue-chip asset class, universally admired.
Yet, they describe a specific preferred stock in a New York City development where the terms were so unfavorable that they entirely wiped out the supposed safety of owning Manhattan property.
Okay, let's look at the three structural problems that made this specific security so dangerous. First, the provisions.
The preferred stock was contractually junior to a massive first mortgage.
And for the preferred shareholder, that means during any financial stress or liquidation, the entire value of the land and building goes to satisfy the first mortgage holder before the preferred stockholder receives a single penny.
So the preferred stock was structurally weak, having a junior claim to the assets.
Second, the capital structure was rigged. The common stock, the true residual equity, represented essentially no cash investment from the initial owners.
If the common equity holders have very little skin in the game, they have very little to lose if the project fails. They are incentivized to take high risks because their downside is limited.
Right.
But the preferred holders who did invest cash have their entire capital at risk. That's a fundamental misalignment of incentives.
And third, the status and price. It was a new building constructed at an extremely high cost level, and there was no cushion of junior capital or reserves. And the 6% dividend was actually lower than the yields available on stronger real estate second mortgages at the time.
So the conclusion, even with the soundest enterprise New York real estate, this specific security was fundamentally unsafe because the contractual terms were fragile, poorly priced, and structurally inferior.
The terms failed, not the underlying property. That's the power of the enterprise versus terms lens. Sound enterprise, unsound terms, disastrous result.
Now let's look at the contrasting example, which flips the script entirely. It shows how attractive terms can rescue an investment in a highly disfavored industry.
The enterprise here is electric railways, or traction, which by 1932 was considered a dinosaur industry.
Yeah, obsolescent, facing heavy competition from automobiles, subject to tight regulation, generally highly unattractive to invest in.
But Graham and Dodd point to the Brooklyn Union Elevated Railroad First Fives, which was selling for only about 60 cents on the dollar in 1932, yielding around 9.85% to maturity.
And the key is, again, the terms. By contract with the City of New York, this bond was a first charge on the earnings of the combined subway and elevated lines, both the companies and the cities.
Wow.
This claim was secured by essential infrastructure representing an investment far larger than the bond issue itself.
The claim was senior, protected by essential public infrastructure, and held by a company that had stable, apparently adequate earning power, even during the depth of the 1930s.
And that high yield, 9.85%, was a direct result of the price being 60. The market was punishing the bond based on the narrative dying industry, not the analytical reality.
Which was strong contractual claim.
Exactly. The math here is instructive. You pay 60 cents, but you receive the full 5% coupon based on the $100 par value, giving you a current yield of 8.33%.
Plus, at maturity, the bond pays $100, guaranteeing a massive 40-point capital gain. That combination resulted in the total yield to maturity of 9.85%.
So the enterprise looked weak, driven by industry fears, but the terms were unusually attractive and protected the investor through seniority and a high contractual return.
This naturally leads to the age-old debate. Is it better to invest in an attractive enterprise on unattractive terms, like a high price, or in an unattractive enterprise on attractive terms, like a deep discount? The growth versus value debate, essentially.
Right, and most people, especially the untrained buyer, instinctively say, pick the great enterprise, the one with the best story and fastest growth.
And Graham and Dodd actually concede that for the average untrained buyer, that instinct is often empirically safer.
How so?
The untrained buyer is far less likely to commit a catastrophic error if they stick to the highest reputation goods, even if they overpay a little, simply because those goods are usually less complex and less likely to collapse entirely.
But for the serious analyst, the principle is more demanding. Nearly every issue might be cheap in one price range and dear in another. The assessment must be specific to the variables S, P, T, and I.
This is a demanding principle because it requires you to set aside your personal admiration for a company. It means the outcome is determined by your disciplined judgment, not by the quality of the company alone.
It forces you to be specific. You can't just say, I love this business. You have to conclude, I like this business, but not at this price.
Or, conversely, I don't love the industry, but the terms of my contract give me extraordinary protection and a margin of safety that makes the price attractive.
If you confuse reputation with analysis, you are paying for past performance and hopeful futures. Graham and Dodd note that many of yesterday's leading enterprises inevitably fall back in the ranks over time.
The status of market darling is temporary.
Exactly. Your job is not to predict which giant will stumble or when. Your job is to avoid paying a price that fundamentally assumes they can't stumble.
You have to pay a price that allows for the inevitability of human error, competitive forces, and technological disruption. The only way to guarantee that is by insisting on strong terms, a low price, and a wide margin of safety.
That concludes our detailed walkthrough of the four-factor question. Let's just cement it in our minds one last time.
Should security S be bought or sold at price P at time T by person I? If you internalize that structure, you will have a more disciplined process than most market participants who are simply chasing the next hot ticker.
Now we shift gears. Once you decide you might look at a security, Graham and Dodd introduce a fundamental constraint. Analysis could go into infinite detail.
This is a practical problem. The investor's time and mental bandwidth are limited resources. You have to decide where the marginal benefit of another hour of research becomes negligible or potentially even negative.
They outline several constraints that influence the required depth. One is scale. Someone buying a small position for a personal account won't commit the same level of proprietary research as a multi-billion-dollar insurance company buying a massive block of securities.
Right. The risk-reward for the time spent is totally different.
Another constraint is purpose. If you are selecting a bond position yielding 3% that is rated AAA, you don't need the same intense analytical effort as trying to find a deeply secured issue yielding 6% or trying to unearth hidden value in a common stock bargain.
And crucially, there's accessibility. Data exists in abundance, often buried in mountains of reports and non-essential footnotes. We can waste time analyzing non-essentials simply because they are available, rather than focusing on the material facts.
This point resonates so much today. We have more quantitative data than ever before, often leading to less clarity. The digital age has amplified the risk of mistaking activity reading thousands of pages for genuine insight.
It's so easy to obsess over the minor details in the operating expense line while completely missing the central competitive dynamic of the business or a pending regulatory change.
So we offer a rule of thumb to guide your time, match the intensity of your analysis to the fragility of the investment.
If the downside is severe, if you're buying an unsecured claim on a heavily leveraged business with declining cash flows, you need a level of due diligence that is almost paralyzing, or you should simply pass.
Exactly. The risk profile demands that depth, but if the downside is intrinsically limited by strong seniority, clear asset collateral, and robust cash coverage, you can often do a simpler, focused analysis on the maintenance of those core protections. The margin of safety is doing the work for you.
They also stress that some significant information is proprietary, like details on intellectual property, specific geographic advantages, or complex non-public labor agreements.
And if you don't have the specialized expertise or the resources to obtain that proprietary insight, you have to acknowledge that some material facts are unknown.
Right. You then size the position smaller, or you move on. The worst mistake is to pretend you know what you don't know.
If the analysis requires an insight you cannot obtain, the margin of safety you require must be widened considerably to account for that acknowledged uncertainty. Because unknowns do not disappear when you ignore them. They simply wait patiently to materialize later as a severe, unexpected loss.
This leads to the idea that the value of specific data varies dramatically by the type of enterprise.
A 5-year earnings record for a highly stable, regulated railroad or a large, established chain store can be highly meaningful. The inherent stability of the operation means past results are usually indicative of future performance.
But take the exact same 5-year record for a small oil producer. That data may be entirely misleading because the results depend heavily on two highly volatile factors outside of management's control.
The unpredictable market price received for the commodity and the actual production volume, which is subject to geological risk and depletion.
You cannot worship the same ratios in every industry. A price-to-earnings ratio of 10 for a stable, regulated utility means something fundamentally different than a PE of 10 for a cyclical mining company during a commodity boom. The context changes the meaning of the numbers.
This is a crucial forward-looking point. As industries evolve through technology, regulation, or globalization, the predictive stability of the underlying numbers changes too. You must constantly reassess the relevance of the historical data you are analyzing.
Which brings us directly to the great division: quantitative versus qualitative factors.
Graham and Dodd divide the elements of analysis into these two families. Let's start with the quantitative.
Quantitative factors are the statistical exhibit, the hard, measurable data found in the financial statements, including the income statement and balance sheet. This also includes operating data like production volumes, unit prices, costs, utilization capacity.
All the numbers. They group these broadly into capitalization structure, earnings and dividends, assets and liabilities, and core operating statistics. These are the elements that can be neatly categorized, counted, and calculated.
Qualitative factors, on the other hand, cover the elements that are harder to measure. The nature of the business itself, its competitive position, its geographic advantages, the quality and integrity of management, and the overall outlook for the company, its industry, and the economy.
And here is their core controversial claim. Quantitative factors lend themselves far better to thorough and reliable analysis than qualitative factors do.
Why? Because quantitative factors are fewer in number, they are easier to obtain objectively, and they are better suited to definite, measurable conclusions. You can prove, with numbers, whether cash flow covers interest payments.
Furthermore, a strong, consistent quantitative record often embodies many qualitative elements. A decades-long record of superior financial results is empirical proof of good management, a strong competitive position, and resilience, all condensed into a few financial metrics.
But, and this is the crucial caveat, numbers alone are insufficient. They can be incomplete, manipulated, or actively misleading.
They can be vitiated or defeated by qualitative considerations of opposite import. A security might look statistically fine based on current earnings, but if the long-term outlook is precarious.
Like due to a massive, imminent technological disruption.
Exactly. Or if management has a history of untrustworthy behavior, rejection is absolutely justified, regardless of the current PE ratio.
This is where we hit the danger zone. Qualitative factors often get overemphasized, especially in heated, high-growth markets.
Because qualitative factors are focused almost entirely on the future, on potential, on disruption, on narrative, they are inherently exciting and speculative. They speak to hope rather than hard evidence.
And when values rely chiefly on outlook and narrative, mathematical controls disappear entirely. Judgments are then carried to extremes, driven by collective optimism, divorced from the ballast of historical performance.
This phenomenon is why market overshoots are so dramatic. Investors don't just adjust the price based on new earnings. They rewrite a heroic story about the distant future and price in perfection for the next 20 years.
Graham and Dodd draw a foundational line here. Analysis is concerned primarily with values supported by facts, historical and current not values, depending largely on expectations of an unproven future.
The analyst's approach is fundamentally conservative and protective. The speculator's success turns on accurately forecasting the future. The analyst's success turns on being protected if those forecasts are wrong.
Relying on the margin of safety as a buffer against uncertainty.
Exactly. The analyst treats the business future as a hazard, a risk to be managed and protected against, not as a guaranteed reward that justifies any current price.
Yep.
You are not paid for being the most optimistic person in the room. You are paid for bearing uncertainty with discipline and minimizing the probability of permanent loss.
Now let's look at three specific qualitative elements that Graham and Dodd say are most prone to analytical self-deception: the nature of the business, management, and trend projections.
Okay, first, the general idea of future prospects and industry quality, what people refer to as a good business.
Investors naturally form strong opinions. We know the historical lists. Industries considered backward during the prosperous 1923-1929 period included coal, cotton goods, lumber, shipping, and street railways.
Right. And the list of darlings included chain stores, cigarettes, motion pictures, and public utilities. The natural human inclination is to avoid the bad and buy the good. But that tendency is precisely where the cycle traps the undisciplined investor.
Graham and Dodd caution that abnormally good or bad conditions rarely last long. The system is designed to correct itself.
Corrective forces tend to restore lost profits where they have vanished, because capital leaves the area, and reduce excessive profits where they exist, because capital is relentlessly attracted to those high-return areas.
Right. Consider industries with rapidly growing demand. That growth is often offset by an even faster growth of supply, leading to brutal price wars and competition that quickly compresses returns.
They cite early examples like the radio and aviation industries. Massive revolutionary demand, but they attracted so much capital and competition that profit margins for most participants were eventually decimated. The modern application is clear. Growth attracts capital, capital attracts competition, and competition compresses returns.
This means the idea of a good industry is highly slippery and subject to unpredictable cycles, demanding humility in forecasting. You can have a strong, accurate opinion about future sector growth and still lose money if competitive behavior is brutal.
And here's the modern application, linking back to factor 3, price. You have to completely separate the question of business quality from the question of business pricing.
The business can be truly wonderful, objectively high quality with a massive moat. But if it is priced as if it's miraculous and immune to gravity, the resulting investment will be poor.
Conversely, a business can be mediocre, a struggling cyclical commodity producer, and priced as if it's already dying, selling for a fraction of its liquidation value. If that mediocre business merely stabilizes, the return to the investor can be excellent.
Your ultimate return is dictated by the size of the gap between fundamental reality and what the market has priced in. The job of the analyst is to find the discrepancy, not merely admire the quality.
Next, the management factor. This is the single most common and most tempting justification for overpaying for a stock.
Everyone loves to rely on the reputation of a charismatic CEO or founding team, but objective tests for management skill that are truly independent of the financial results are incredibly scarce.
We often rely purely on reputation, which can be dangerously misleading when market cycles turn or when the competitive landscape shifts.
Graham and Dodd note that the most convincing proof of superior management is a superior financial record over time. This immediately pushes analysis back toward the quantitative data as the primary proof source. The numbers should demonstrate the skill, not just the CEO's press clippings.
Then they deliver the key warning that still applies perfectly in the era of founder worship. The market tends to value the management factor twice.
Okay, let's break down the double count.
First, the stock price already reflects the high earnings produced by that good management. The quantitative data is already excellent, resulting in a high valuation.
But then the market adds an extra separate premium halo effect, simply because people admire the genius or reputation of that specific management team. They are counting the same trick twice.
You are paying a high price for the results already delivered, and then you are paying an extra layer of speculation for the hope that this genius is permanent, flawless, and immune to competition or retirement.
This error converts justifiable admiration into dangerous overvaluation. You are betting that the management is superhuman and that the success is locked in forever.
It also turns investing into personality worship. When that leader inevitably departs, makes a mistake, or simply ages out, the investment thesis, which was overly dependent on one person's continued brilliance, collapses, taking the premium with it.
A disciplined investor must respect management, but still demand a price that allows for normal human limitations, the certainty of competition, and the eventual certainty of change. You have to assume management is merely competent and aligned, not that they possess superpowers.
Now, the trend. This section is surprisingly modern because today, trend-based thinking and long-term projection dominate every financial discussion.
Trend-based thinking is seductive. People project revenue growth, margin expansion, and earnings growth far, far into the future, often 10 or 20 years out, and then use these projections to justify massive valuations today.
Graham and Dodd are clear. A record of increasing profits is certainly favorable, but projecting that trend indefinitely into the future is not mathematically sound, even if you use a sophisticated spreadsheet to calculate the compound annual growth rate.
The distinction is vital. A past trend, however long and impressive, is a historical fact. The future trend is merely an assumption. And the longer you project that future trend, the less you are doing rigorous analysis based on known facts, and the more you are engaging in psychology and narrative creation.
Security analysis, they argue, does not assume a past average will repeat forever. It uses the past as a rough index to establish a baseline of earning power and stability, an anchor point.
A trend, by contrast, is a definite prediction. It is a binary bet that must be either right or wrong, and the consequences of being wrong are often traumatic.
Let's look at their concrete examples, which illuminate the concept of the margin of safety, which guards against the failure of a forecast.
Consider a high-grade railroad bond in 1929. The railroad had earned its annual interest charges 3 times over, on average, during the prior 7 years.
The analyst is comforted by this threefold coverage. It suggests a massive margin of safety, indicating the bonds are unlikely to be endangered even if earnings decline by 50 or 60%. The safety is structural.
And notice the analyst's conclusion. The comfort comes from the current margin, the room for decline, not from a forecast that earnings will continue to cover interest 3 times forever. The safety is in the current terms, not the future trend.
Now compare that to what happened with public utility systems of that era. Earnings were rising steadily, creating a powerful growth narrative, but fixed charges were often very heavy, consuming nearly all net income, leaving only a tiny margin of safety.
So investors bought bonds in these thinly covered utilities on the explicit overriding belief that earnings would keep rising forever.
They substituted the aggressive trend forecast for the required margin of safety. That is a pure trend bet. When the forecast failed, when growth slowed or reversed due to the Great Depression, the tiny initial margin disappeared entirely and the investment failed.
The forward-looking lesson is critical. Whenever the safety or intrinsic value of an investment depends entirely on continued uninterrupted growth, you are not buying protection or safety. You are buying a story that is inherently fragile.
Sometimes the story comes true, but protection isn't found in the story's veracity. True protection is only found in the terms, the price paid, and the measurable margin of safety relative to historical earning power.
If your investment thesis collapses when growth merely slows down, or if the multiple shrinks back to a historic average, you are operating closer to speculation than you think. You need to reclassify it and size your position accordingly.
Graham and Dodd then focus on the most important qualitative factor for the analyst, inherent stability.
Stability means resistance to competitive, economic, or technological change. This is the quality that makes past results actually dependable as a guide for the future. Without stability, your quantitative analysis of the past is useless.
They make the subtle point that stability can be quantified through numbers like earnings variability, but it is fundamentally a qualitative trait derived from the character of the business. Does the underlying service or product possess durable, recurring demand?
The historical numbers might suggest stability, but other qualitative considerations like high fashion risk, imminent technological disruption, or cyclical commodity exposure can rebut that suggestion, proving the stability is temporary or cyclical.
They offer a phenomenal comparison that crystallizes this entire lesson. Two preferred stocks in early 1932. Studebaker, a major American auto manufacturer, versus First National Stores, a regional grocery chain.
Both were considered sound investments at the time, selling above par, and both had satisfactory dividend coverage based on historical earnings.
But when you look at the quantitative coverage ratios, Studebaker's looked far superior on average. The company earned its required preferred dividend more than 20 times over.
Wow, 20 times.
It was statistically superior in terms of coverage. The grocery chain's coverage, by contrast, was in the mid-single digits on average. Still decent, but certainly not dazzling.
So if an investor relied purely on quantitative dividend coverage, they would logically conclude that the Studebaker preferred stock was the safer investment.
But if they looked at the qualitative nature of the business, they would have made the correct contrarian choice. The grocery trade, in a fundamental sense, possesses inherent stability. Demand for food is stable and non-cyclical. Locations are diversified. Inventory turns over rapidly.
A well-managed chain, avoiding reckless expansion, is structurally resistant to wild earnings swings. The business is predictable.
The auto manufacturer, Studebaker, however, faced a radically different qualitative reality. The industry is capital-intensive, extremely cyclical, and individual company success is subject to intense volatility.
Consumers defer car purchases during recessions. Product cycles are intense, expensive, and high risk. Competition is absolutely brutal and continuous. Past stability is not proof of permanent immunity.
So the conclusion: the grocery preferred stock was intrinsically sounder as a fixed value investment, a safe harbor, than the auto preferred, despite the auto company's far superior historical coverage ratios. The numbers were temporary, the business structure was permanent.
And history confirmed this analysis. The grocery business maintained its earning power, and the preferred stock was eventually redeemed at par without issue. Studebaker's earnings collapsed severely, a receiver was appointed, and the preferred stock lost most of its value.
The takeaway is clear. The raw numbers matter immensely, but their predictive power depends entirely on the inherent stability of the business. You have to view the numbers through the lens of qualitative stability.
You have to ask if the business possesses structural stability, a sustainable competitive moat, and relatively inelastic demand, not just a stable-looking chart over a temporary period of prosperity.
Stability comes from repeat contractual demand, diversified customers, pricing power, regulated frameworks, or providing truly essential non-deferrable services.
And instability comes from fashion risk, exposure to volatile commodities, high technological disruption risk, or reliance on aggressive financial engineering. Your margin of safety requirement must always be significantly higher when inherent stability is lower.
Okay, let's convert the lessons of Chapter 2 into a practical, repeatable framework you can use immediately the next time you face a buy, sell, or hold decision.
We'll structure this in 2 layers. The mandatory 4-factor checklist first, followed by the disciplined Quant versus Qual filter.
Layer 1 is the foundational question. Commit this to memory. Should security S be bought or sold at price P at time T by person I?
Now, answer the factors systematically, starting with person I. What is the explicit job of this capital in your life? What constraints liquidity needs, tax situation, time horizon, and emotional temperament matter most? If the security violates your personal constraints, the analysis ends there.
Next, time T. What is the broader market environment telling you about the cost of capital and the opportunity set? What do safe alternatives truly yield? Are stress and liquidity factors currently dominating the market mood?
Then, price, P. What actual rate of return are you buying when you commit your capital? What specific expectations for future performance are embedded in the current valuation? Are you paying twice for management? What happens to your capital if the valuation multiple simply compresses back to its historical mean?
Finally, security, S.
Correct.
What is your precise claim, status, senior debt, junior debt, or residual equity? What are the contractual terms and covenants that protect you? What does the capital structure look like? What is the core definition of the enterprise itself?
Okay, layer 2 is the disciplined process for assessing the security itself. Quantitative versus qualitative, and you must start quantitative.
The simple quantitative checklist. 1. Capital structure, seniority, fixed charge burden, and leverage. 2. Earnings and cash flow. Is there adequate coverage of obligations across a full business cycle? 3. Balance sheet, health, liquidity, debt maturity schedule, and asset quality. 4. Operating statistics, the non-financial key metrics specific to the business.
Then, and only then, you apply the qualitative overlay, but you have to keep it disciplined and focused on risk, not just potential upside.
1. Business stability. How likely are the past numbers you just analyzed to remain relevant? 2. Competitive dynamics. Is success likely to attract fierce competition that erodes margins?
3. Management incentives. Are they aligned with long-term owners? And are you successfully avoiding the double count of their reputation? 4. Trend humility. Are you relying on continued growth for safety? Or is growth correctly defined as an optional bonus on top of a fundamentally safe investment?
And we must emphasize that final critical qualitative item which permeates the quantitative results. Accounting clarity.
Good one.
The quantitative numbers are only as trustworthy as the transparency and honesty of the reporting. Aggressive accounting, excessive complexity, or opaque disclosure is a qualitative factor that severely weakens the trustworthiness of all your quantitative analysis.
So if the numbers are hard to trust, the entire analysis is weak, regardless of how great the spreadsheet looks. You have to apply a higher margin of safety or move on to a simpler, more transparent enterprise.
Let's run those 2 mental model exercises again using this framework to solidify the practical application of price and terms.
Exercise 1. The wonderful business at the wrong price. You've identified a truly high-quality business that earns $10 per share steadily and consistently.
If you pay $300 per share, a 30 times earnings multiple, you are assuming not just stability, but either drastically higher future earnings or a permanent maintenance of that highly elevated multiple.
So if the business performs exactly as you predicted, $10 per share earnings, but the market multiple reverts to its historical mean of 15 times earnings, $150 per share, your investment is cut in half.
A disastrous loss of capital. The business was fine, your analysis of the enterprise was accurate, but the price factor punished you severely for your excessive optimism and the failure to account for competitive mean reversion.
Okay, exercise 2. The unloved industry with unusually good terms. The lesson from the Brooklyn Elevated Railroad bond.
You find a senior secured bond in a fundamentally disliked or highly cyclical industry. It sits high in the capital structure, has clear contractual protections, and trades at a steep discount, say 60 cents on the dollar.
The enterprise does not need to be miraculous or fast-growing. It only needs to be adequate enough to limp along and meet its fixed charges.
And your upside comes entirely from the terms. The high contractual yield, the guaranteed pull-to-par at maturity, and the strength of your senior claim, which provides a massive margin of safety against the market's negative perception.
These exercises show that Graham and Dodd's framework is fundamentally about structural discipline and risk control, not about picking winners.
It's about structuring the decision to define what must go right, what can go wrong, and whether the margin of safety dictated by the terms and price pays you enough to accept the inherent uncertainty.
All right, let's crystallize the core lessons from Chapter 2 in plain language, 7 points that you can carry into your decision-making.
1. A complete investing decision must include all 4 factors: security, price, time, and person. Most mistakes arise from ignoring one of your personal or environmental constraints.
2. The terms you receive, your contractual standing, seniority, and price matter just as much as the quality of the underlying enterprise.
3. Quantitative analysis is the analytical backbone, providing objective evidence, but it can always be overridden by adverse qualitative realities like untrustworthy management, or imminent obsolescence.
4. Beware of trend-based math. A projected trend is a fragile forecast, not a fact, and should never be relied upon as the source of your investment safety.
5. The most important qualitative trait is inherent stability, because stability is what makes the historical past a relevant guide for the future.
6. Never double-count management. If great management has already produced great numbers, do not pay twice for the same trick by adding a premium for their reputation.
And 7. Your ultimate goal as a long-term investor is not to be the most clever or the most predictive person in the room. It's to be durable, to make decisions you can confidently live with through inevitable market cycles and human errors.
That structural discipline is the only reliable way to compound capital over decades.
That concludes our deep dive for today. You've been listening to Capital Allocation Lab, an audio-first library translating great books on capital allocation and fundamental investing into practical decision tools.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
We'd love to hear from you. We've covered the 4 factors. What part of that equation do you find yourself tending to ignore? The constraints of the person, the time environment, the price, or the security terms itself? Let us know in the comments.
Also, tell us what fundamental investing concept you'd like us to dissect next. The margin of safety. Owner earnings versus reported earnings. Return on invested capital. Send us your suggestions.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.